On this morning's Ag Issues program, a pleasure as always to bring onto the program Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
I'm fine, Greg, and based on the weather, it's like I was lucky that I made my western Kansas swing last week through Dodge City and Garden City and Hayes instead of today or this week.
You beat it out just in time. All right, let's get to it. One of the things that, like any farmer does, they sell their harvested crop, and I think most everybody knows that the tax rules surrounding and the reporting of the income from the sale are well understood. But let's throw in the situation, be it tragic, but it does happen. What happens when a farmer passes away during the growing season? I would assume, Roger, that the tax issues definitely get more complicated as far as the sale being tied to the status of the decedent at the time of death, too.
Mm-hmm. Yeah, they do get a lot more complicated than as to whether the deceased person, the decedent, was actively farming at the time they died, or whether they had returned from farming to a cash lease, or if they had returned operating with the tenant with a material participation lease, and then what type of material or what type of a crop share lease. Was it material participant? Was it some sort of a non-material participation crop share lease? Because all of this from a tax standpoint, because the heirs are concerned primarily about an increase in of that crop or the livestock when it's sold. And the rule is that property that's included in the estate for tax purposes at death gets a new basis under the Internal Revenue Code to the fair market value of that property at the time of death. And we have pretty well-established markets just about all commodities, particularly the major grain crops and livestock. We can figure out what the value that was, either on a per bushel basis or on a weight basis at the time the decedent died, and it's basis to that fair market value at the time of death. To sell the crop, that makes a difference to them. Otherwise, you don't have an income tax basis in raised grain or raised livestock. You would in breeding livestock that have been purchased. And the heirs don't want to have to sell the grain or the livestock at a zero basis and incur all that gain. So this is an important issue, and we have to sort out what causes it to have an increased basis at death.
Now, there are, and I'm sure there have been cases throughout the years that look at that. Has the courts, be it the tax court or whichever court, that's where they set the requirements that you need to have, or that you need to follow, or that you need to be able to say that you've been able to do that with regards to...
Right.
Or I think you know where I'm going with that question. Let me ask that.
Yeah. And what this comes down to is a concept known as income in respect of decedent. That type of property does not get any basis step up at death, and that's tax. By definition, it's taxable income that the taxpayer earned before death that is received after death. And it's not included on the decedent's income tax return because the taxpayer, the decedent, was not eligible to collect the income before death. So the question then comes down to the courts. All right, what kind of stuff might a farmer have, since we're talking about farms here, what kind of items might they have that triggers the rule? And there are a couple major ones at death, and then I'll come back to the crop. But if you've got an installment land sale contract that you've entered into, and then you die before you've received all the payments, then the end of the contract, your heir, who's still going to get the land contract payments, doesn't get an increase. And that was deemed to be incomplete at the time you died. No basis increase in those payments as they come in. And that can be a big deal because that land basis may be really low. And so there's not much of a base remaining in that contract. So that's a problem. Another one would be CCC loans. So if you've taken out a loan with the Commodity Credit Corporation before death, and that's still in existence at the time of death, the recipients of $100,000 CCC loan will not get an increased basis in that. And that's two big ones. Now, when we bring the concept to livestock and crops, we apply the same principle. And this is where I come back to what I said earlier. It depends on whether the decedent active farmer or a landlord. That's how we classify income received after death as income of decedent or not. And so if they were a farmer, then they don't have income in respect of decedent. That is going to be farm inventory, and we're under the normal rules. If they were not participating as a landlord, so they were a cash, so they had retired, cash leased the land out, or were operating under a lease, maybe they had structured it for Social Security tax so that they weren't materially participating, then we get into the IRD issue. And that means no income tax basis increase at death to fair market value in those payments coming in under the lease and the recipients. Another is that farmers don't always time their deaths appropriately, and they die after planting a crop, and so they die before the crop, or we're mid-cycle the growing season with respect to livestock. When in that situation, we've got a valuation issue. How do you value a crop that's growing? It's been planted. It hasn't been harvested. What's the value of that? Well, there are a lot of things that could happen to that crop. You may not get anything because it could be destroyed by weather. How far into the season are you? Has it germinated? Has it come up? Did you die just after planting it? Or almost right to the end of the crop growing season, right before harvest? That presents some tricky issues. The 58 revenue ruling from the IRS on this that tells us how we value those crops. And the same principle can apply during the growing goal of livestock, too. And it's based on how far into that process you are, and there are formulations that have to be made. It gets pretty complex to determine what the value of that is in the hands of an active farmer.
Now, there's a term, too, the character of gain, that we can look at as well. Mm-hmm. So let's just say grain that is raised by a farmer and held for sale, or maybe they're going to feed the livestock, that would be considered the inventory in the hands of the farmer. So how is that handled with regards to sale of the grain?
Yeah, that's right. That grain is sold, those needs are treated as ordinary income for income tax purposes. But when the farmer dies and the estate then sells the grain, and the rule has been that if the sale occurred within 6 months after death, the income from the sale qualified as long capital gain. But that's now 1 year. That was changed a few years ago. The 2-year holding period requirement that is there for sort of what we call 1231 assets, such as cattle and horses, that still applies. So 2 years if you're dealing horses, it's 1 year to get long-term capital gains for dealing with crops. But ordinary income treatment of the crop was raised on land that was leased to a tenant. So again, sort through all these rules, and it gets pretty tricky.
Okay, so let's say then the decedent operated a farming business in a partnership or a corporation. Then how is that grain handled? I would assume from the entity itself. So how does that work as far as character of gain is concerned?
The entity is liquidated when the decedent dies, and then the grain is distributed from that entity. That could be from Tory treatment to a capital asset. But to get capital asset status in the hands of a partner or holder, that partner or shareholder can't use the grain as inventory in a trade or business. And so that status is most likely when the partner or shareholder does not continue in the farming business after the entity's liquidation. And so it's easier to get capital asset treatment if there's a liquidation of the entity when the deceased individual dies.
So throughout all this, that's, or I guess emphasizes an importance of keeping up to date with the tax preparer, your lawyer, or whatever the case may be, if a family or whatever the case is, they run into this type of situation.
Yes, and this happens all the time. Just shows you, well, some of us farmers to others, it is incredibly confusing and difficult. So the person that you're working with, professionals that you're working with, need to know these rules. These are pretty technical rules, and it's not always comes out when a farmer dies.
Oh, one other thing on that. So, from the perspective concerning income tax, obviously you have growing costs that are incurred by the farmer. Depending on the time, obviously, this may happen. What happens then, I guess, after that concerning the growing crop itself? Is this all really based on timing as to, what is taxed, what is sold, or however that may be?
Yeah, and let me give you an example of a fascinating case. This came out of Nebraska a few years ago, and we had pre-purchased about $250,000 worth of crop inputs, which farmers do as a means of tax planning. Many do that, and so he goes in December, for example, to be able to deduct that on the current year's return. Does take the deduction return, is ready to starting in March into April of the next year, but he died right before planting. Everything goes to his wife. So what he uses those inputs, plants the crops, and is deducting the cost of the inputs on the next year's return. And she get a deduction on the prior year because he purchased it that year. She gets a deduction on the next year because she used it. IRS head explodes, and the tax court said, yeah, that's right, because he's a farmer, you get a basis step up in those inputs, but she gets through the millisecond time. That's a pretty nice result. Now, granted, he died. That's a bad result. But from a tax standpoint, that's the way it works.
Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, is joining us. And Roger, looks like there seems to be still some misunderstandings among some farmers about tax deferability of crop insurance proceeds. And I know in the blog you posted that you've had several comments or seen several comments on social media, farmers communicating with each other, stating to the effect that crop insurance is always deferrable, but that is not necessarily the case.
No, that's not the case. And farmers and others need to that IRS also sees what's posted on Facebook and other social media, and they can track you down. You don't want to get into an audit because of misinformation you put on the website, on social media. But I have seen some comments by farmers saying, well, I always defer it. My crop insurance, that's what they tell me, and we figure out a way to do it. Well, wait a minute. Let's go through the rules. Yes, it's possible. But deferability is possible if you're on the cash method of accounting and you have a practice of reporting the crop income, because crop insurance rules allow you to do is maintain that consistent tax treatment. So if I have gotten into a pattern of deferring income from crops by using deferred payment contracts, then I can keep that same tax treatment if I don't get a crop, but I get crop insurance instead to replace as replacement for that crop income. So that's the second requirement. The third requirement is that the payments have to be for crop damage. They have to be on account of actual physical damage or destruction to crop. So that would include crop insurance. That includes prevented planting payments, and it can include disaster payments. It does not include all, for example, of the revenue protection or yield protection policy payments that are made. Only the portion that's attributable to actual physical damage or destruction to crops paid under those policies is deferrable. Anything that is attributable to yield loss or revenue loss is not deferrable. And then I want to emphasize that with respect to these ERP payments, these emergency relief payments that have gone out there, those are deferrable, period. I've seen a lot of information. Farmers think those are deferrable. They are not. Those payments received this year were for destruction or damage to crops that occurred in 2020 or 2020. If you were receiving those in 2022, you cannot defer them any further. They've already been deferred. Now, if there happens a second round of payment that is for 2022, you can defer those into 2023 if you receive payment this year. But other than that, those are not deferrable. There's been a lot of confusion on all this recently, and I'm just sure that farmers are clear on that so they don't get into trouble.
Yeah, because since the IRS hasn't really specified in their regulations, a quote-unquote appropriate manner to be utilized in determining what is deferrable and non-deferrable, is there, for lack of a better term, is there an acceptable approach on how to look at that?
Well, I came up about 7 or 8 years ago and ran this IRS context I have in D.C., and they looked at it and they contacted me back and said, yeah, look at us. Now, that's completely unofficial. That is off the record. That's not Internal Revenue Bulletin, and you're right. They have made no official pronouncement on this. But in my blog article recently of Friday, I put that example in there, and people can go look at that, and I think that's going to provide help in a portion of a yield protection or revenue guarantee policy is deferrable and the portion that's not. And look at that, plug your ears, do the math on it, and see how it would work. Again, that's unofficial. I state that in the blog article. IRS has not ever gotten around to publishing on this, but at least unofficially, they have said to me, yeah, great, and that's an appropriate way to pick this apart. But again, I come back to where I started, and that is you've got to make sure crop insurance is deferrable, and it's not always deferrable, and ERP is not. Let's make sure we're clear on that and get that message out.
So one other, I guess, I'll throw out a situation there. What should what is the best advice, especially for those who, for their crop insurance, they've got multiple crops that are involved in this? How should they approach it? Just some of the things that you've stated earlier. Yeah, that gets even trickier because the IRS rule on that, if you have say corn and you've got soybean, then a substantial portion test has to be satisfied with respect to each crop associated with a separate business of the owner. So if you have a separate business entity that's created, one for your wheat, one for your soybean, one for your crops, then it's a lot easier to meet the test that, well, I have a practice of deferring with respect to this crop. Because you've already segregated things out, it's easier to prove that. If you can't do that, otherwise, the 50% test, which means most of the time, most of my crop income I defer into the next year, has to be computed in the aggregate. So we would take all the corn, all the soybeans, all the wheat, throw it together, or we were 50% of deferring with respect to that single business. And you may you can't elect to defer just a portion of the insurance proceeds to next year. So I've got to clear a 50% threshold, and once I clear it, I can't pick and choose how much I defer and how much I include them. Once I clear it and I want to defer, I defer 100%. So again, that's another twist that's in these rules. And so if you hear talk at the coffee shop or down at the local cafe, be really, really careful. Run it past your tax professional and understand tax. All right, Roger, we're out of time, but for what we talked about today, you've both of these posts are on your blog.
Yes, they are. Within the last kicks, they're both there.
All right, sounds good. Well, Roger, as always, very much appreciated, and we'll see you in Kansas City on Wednesday.
That's right. I'll be there Wednesday morning at the National Association of Farm Broadcasters meeting, and that's after an all-day conference tomorrow for the North Dakota CPAs.
All right, sounds good. Roger, take care. Appreciate it. That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the Ag Issues program here on 580 WIBW.